And what's the benefit of a SBA loan? Is it that the lender or the borrower couldn't otherwise get financing?
Well, from a regulatory standpoint, the lender has to prove that that is the case. And oftentimes what that means is a lender is actually signing off on the loan saying, we would not otherwise make this loan under the same terms and conditions that SBA can provide. And so a real good example of that, Paul, is on owner-occupied commercial real estate. Most banks will finance things at 75 to 80% loan to value. If they wouldn't do that for that client, for whatever reason, maybe they don't have enough net worth in the business or personally, maybe their bank is just not comfortable doing anything more than 80% loan to value, that enables them to say, we only will do this under an SBA program. So that's an example of that. Yeah.
And SBA doesn't provide the funds or a guarantor, is that right?
That's right. SBA, think of it like an insurance product.
Okay.
Yeah.
So what is a typical, when you think about like a partnership buyout or business acquisition 7A loan, what are typical terms in today's environment?
Well, it depends. Anything non-real estate backed, you're going to typically do a 10-year term, okay? No balloon payment. It's fully amortizing the 10 years. Most of those products are done at 90% financing. Not all. There's a few situations that you could do higher than that, but mostly it's 90% financing. And by comparison to ordinary conventional banks financing it, you're looking at 70, 80% at best, sometimes even lower, depending on the use of proceeds. Yeah.
So basically, somebody's coming up with 10% of the equity of the total transaction value, whatever it is. The bank comes in with 90%.
Yeah, that's the biggest one. I mean, I would say it's much lower down payment, which is very valuable for most small businesses because they can preserve more of their precious capital. Usually it's a half to a third of what the alternative is. They're getting a longer term, business acquisitions, for instance, if you're able to get one done with a conventional bank for a small business, which isn't very often. You might get it on a 3 or 5 year term, not a 10-year term. Banks are not going to do that conventionally. Same with partner buyouts. You might get a 3 or 5 year term versus a 10-year. So you have a much longer repayment, which means it doesn't impact your monthly cash flow as much. So those are two big things. The third thing I would say is SBA doesn't have a bunch of strings attached to their loans. So long as you make your loan payments, you're generally going to be in good stead with SBA. There's no restrictive loan covenants, which again, people kind of chuckle when I mention that. In good times, that doesn't matter. The problem is in bad economic times, it does matter. The bank quickly can sour on a particular, industry type.
Put you in technical default overnight.
Technical defaults happen all the time. Yeah, and it can be dangerous. You don't have those issues with SBA. So,
are there any specific borrower profiles that make sense for an SBA loan versus those that don't? I mean, what sort of criteria are banks looking at for that?
Yeah, I would say, smaller companies, obviously. If you're looking at an SBA loan for a business acquisition, then you're not going to probably finance a company that does in excess of, say, 100 million in gross revenue. It's going to be lower than that, maybe a lot lower than that. Same with partner buyouts. I mean, they tend to be more on what I would consider the small to mid-sized companies. I think like Wall Street, we consider them micro businesses, of course. But we do everything from startups all the way up to the 100 million in gross revenue. So it's kind of everything in between. I mean, I would say our typical customer is probably in that $5 to $20 million gross revenue range. Yeah.
What do the banks do in order to determine, when a borrower comes to you and says, hey, I'm buying a business. I need $4 million. Do you guys get involved in saying, okay, is this an appropriate transaction value you're paying? Do you guys solicit third-party appraisals? How does that work?
Yeah, we always have third-party appraisals on business acquisitions, and frankly for equipment and real estate as well. So yeah, I mean, we generally know where things should be, and obviously when we get the valuations back, we take a look at them and to try and determine, are these reasonable comps? Do these multiples make sense? When they aggregated all the different ways to look at it, does it make sense or not? And we've been known to push back to the business valuation firm. But yeah, we have to have those, not just for our comfort, but also for SBA's.
It's a regulatory requirement?
It is.
And when you guys are underwriting these things from a credit parameters perspective, are you looking at like fixed charge coverage? What sort of things are you actually looking at when you model this out?
We're mostly looking at the cash available that's thrown off by the business being acquired. So we're going to look at their EBITDA, basically, predominantly.
These are largely cash flow loans.
Yeah. I mean, it's rare that you're going to have a business acquisition that doesn't cash flow, or unless there's a very well-documented business plan with really detailed assumptions that make sense that pass the smell test to tell us how you're going to turn it around. But in most cases, an acquirer who we finance is buying an existing cash flowing business. So we're going to take a look at the strength of the business itself. And generally, from a debt service coverage standpoint, we're only looking the SBA's minimum, which is a 1.15 times coverage on either the historical numbers or on a projected basis going forward. And I would say that means our credit box is much broader than ordinary conventional lenders like banks. So we're going to look at that, but we're also going to look at the personal financials of the acquirer, of the business owner, and make sure that this isn't going to stretch them too much. We want to make sure they have enough liquid net worth to cover the operations if they get in a pinch. We want to make sure that they've been a responsible borrower in the past. So we'll pull personal credit and not just look at the FICO score, but actually look at the credit report itself and make sure they haven't recently charged off something or been late on their mortgage payment or things like that. So it's a little bit of it's a little art, not just science. And so we're looking at things from a global perspective, and we do a global debt service coverage ratio, which we typically want it to be at least 1 to 1 times.
What about collateral and personal guarantees? How does that work?
So all SBA loans have a personal guarantee, and I know plenty of borrowers have squawked about that in the past. From my standpoint, having been a non-bank commercial lender, where I've historically relied on large commercial warehouse lines of credit, which I have to personally guarantee. I have very little sympathy, as you can imagine, because I've had hundreds of millions of dollars that I personally guaranteed, which, by the way, I don't have. But I can sleep at night because I know I have enough confidence in myself and what we're doing that it's all worked out fine. But yeah, so all SBA loans have collateral. It's a requirement. But we operate a little bit differently than most SBA lenders and certainly conventional lenders in that we follow the SBA's SOP, which means you can't turn a loan down for insufficient collateral. And frankly, if you think about it, that's why the government guarantee is in place.
Because the sufficient collateral doesn't exist. Otherwise,
in most cases, yeah. I mean, otherwise they might be able to get traditional financing. Not always, especially if we're talking business acquisitions. But SBA government guarantee is typically 75% of the loan amount. So I look at that and go, well, that's in essence my collateral coverage right there, but we do have to attach to other things that are available to us. And so, sometimes we take borrowers' personal residences, a second or third position on that. We often will file UCCs on equipment and inventory and things of that nature. But again, we may not be fully collateralized on that loan, and that's okay. We still want to follow the spirit of SBA's rules, which is to still make that loan and not reject it just because you have insufficient collateral coverage.
How do you deal with guys that have, they're based in the United States, they're buying a business in the US, but they've got a couple of homes abroad?
Right.
I mean, it's hard to foreclose on those.
I wouldn't even touch them.
Yeah.
And we sometimes have situations where someone has, particularly SBA, what was it, about 6 or 9 months ago, got rid of what was called the personal resources test, which meant you could get an SBA loan if you qualified, all else being equal, except for the fact that you couldn't be too liquid. In other words, you couldn't be too strong of a borrower. Meaning if
you have $50 million in a passport savings account and you want to borrow $4 million, they're going to say sorry.
Historically, SBA would say sorry.
Okay.
They got away with this rule. And what it was, to be very precise, it was if you had liquid net worth that was unencumbered, non-retirement, that was larger than the project that you wanted to finance, the SBA presumed that you should just pay cash for it, which you and I know that's silly. Why, even if you have cash, why would that's one of the benefits of having cash is you don't have to put it all in. You're an attractive borrower, right? So they finally got rid of that last fall. And what it means is I think it's smart and I've been lobbying for this for years with them. You want to bring in more successful more financially secure borrowers into the program. It actually will enhance SBA's guarantee portfolio by having these people. So no longer do we have these situations where, you know, a doctor wants to buy an office condo, a medical condo, and he's got a couple $100,000 more in unencumbered, non-retirement liquid net worth, and I have to tell him go buy a boat or something in order for us to do the deal, you know, and I've had a few of those conversations over the years. So we don't have that situation anymore, and I think consequently we're looking at much, much stronger borrowers than SBA's ever looked at in the past.